Hello YouTube, step index on a daily time frame. If you notice, I'm on a different platform. This is the MT5 platform. I am having a lot of difficulties with the Deriv TradingView charts platform. There's a whole lot going up there. So I have to make way with what I have, okay? So here we are. Right, our last discussion was aiming for these relative equal highs up here. This is the October's opening price, as you can see, the 1st of October 2025. We've had the initial high of October being printed. I spoke about this in relation to the bearish order block up here. Now, order blocks are essential. I keep repeating this. Order blocks are essential in a consolidation market. And this is one instance of price action using this bearish order block as a resistance. There's a plethora of order blocks in this market condition. When price was returning back down here, it was met with a bullish order block. There is a lot of examples, especially with today's price action. So after we've resisted on that bearish order block, we came all the way down to sweep this particular low. And this down here, I call it a liquidity purge. A liquidity purge is when price action sweeps a liquidity pool and then quickly reverts. It goes into the opposing side. Hello, 20th of October opening price. That is the reversal profile that tends to happen, right? So we had that display of price action going up, and we printed this high, which I called for as the Thursday's weekend price action. It is close to the October's initial high. It is also hitting the bearish order block here, right? So there is buy side liquidity up here. Okay, there is a lot of orders up here. Hence why I am looking for this particular level as a target, right? Why am I doing that? Why am I thinking like that? Well, let's take a moment to reflect on price action. What kind of market condition is this? It is a consolidation market. Here are the resistance levels, right? The bearish order block here. And here is the support levels. Okay, the 20th October's opening price. That is a supporting price point, good people. So we have a resistance and a support. This is the basic idea that I am going with, okay? So bear with me. I know it seems a little bit cloudy at the moment, but we are looking for higher prices, good people. We have tapped into the 20th October's opening price, and I gave you an analogy in the episode 2 of the contrarian trade setup. I was talking about a paintbrush. You as the painter, you want to apply paint on your wall, right? And this is where you start to roll the paint to the upside. As you're rolling the paint, there are some instances where you will roll it too fast. In reference to price action, there are times when it will spool and move too quickly, right? So you start here, you paint to the upside. You roll the paint all the way up into the resistance. If you look back at this price leg from the 20th opening price, all the way up into the Thursday's weekend price action high. If you look into the 4-hour time frame, there are inefficiencies. There are pockets of price action that need to be filled, good people. You had applied your paint only to the upside. And as I said, there are some instances where you rolled the paint roller too quickly. And that results in pockets missing the paint. So what do you have to do? You roll the paint to the downside, right? Back to where you originally started. So what does that mean? It means that price action has printed to the upside, yes, moving from a support all the way up into a resistance. That is correct. But now the range high and the range low, well, what do you do with that information from the range low to the high? Well, since we are in a consolidation market, price action needs to retrace, good people. I know I had the trading idea in here using that 4-hour time frame inefficiency, that pocket of price action. I used it as a support on the 26th of October, teaching you guys how to enter into your new week inefficiencies. This was a valid idea, but it was short-lived. Why? Because price action needed to fill in the range. It needed to paint all the way down to where it began. Does that make sense? Right? So now that we've filled in the inefficiencies whole, there is no need for price action to go down. It had already did a liquidity purge. We are done with the sell-side liquidity pool. The only price action that is of interest, it is the initial high of October. This is what you have to concern yourself with. That is it. And you're using this particular idea that we have filled in the entirety of the range. Okay, we've come all the way down to support on the 20th October's opening price. As I said, this is a sensitive price point. Okay, so now today we have price action going into the upside. Now we're gonna zoom in on the lower time frames and see what we did today with the price action. Step index on a 4-hour time frame. I have put a lot of emphasis on this new weak inefficiency, and you can clearly see that it is bearish inefficiency. Since we began a new trading week on this particular opening price, this is Sunday, we have went up and we printed relative equal highs close to this high up here. Now I teach that whenever this happens, it usually signals an algorithmic signature where it tells you where the liquidity pool is. Same thing that it did with the Thursday's high of our 20th reversal profile going into the upside. We printed this high very close to the initial high of October. So this is the algorithmic price signature. Whenever you have a bias in mind, you need to be watchful of these highs being congested at the same price level. Okay, so I had spoken about the Sunday's opening price, or the highs of Sunday, being close to this buy side liquidity pool. Now along the way, price will print these algorithmic price signatures. And after it prints those algorithmic price signatures, if you are bullish, you're going to see price action drop lower into a discount. And in that discount, in my case, it is the bullish order block of the 4-hour time frame. It is also the opening price of the 20th, real sensitive right here. Okay. Price tends to print a lot of those algorithmic price signatures. It just tells you where the liquidity pool is. All right. So today we opened and we traded inside of the inefficiency of the 4-hour time frame. Our new week inefficiency, yes, we've traded all the way up to 75%. We have printed this high. It is telling us that, hey, you better watch out. This is where I want to go. I have traded above the 50% of that inefficiency. I am bullish. I have supported at a discount the 20th of October's opening price, the order block on the 4-hour time frame. We have supported down here, and we had this consolidation, this mini consolidation, right? Consolidating at the 25%. These are quadrant levels, good people. Since we have a large inefficiency like this, I tend to grade large inefficiencies. Okay, it makes sense for us to grade those key levels because they can be turned into support and resistance, right? So we've had a consolidation. We broke out of the consolidation, traded up inside of our new week inefficiency. You're wondering why I have drawn our inefficiency like this. Normally, we draw the inefficiency like this. The problem with this is that there is a volume imbalance. There is an absence of price action between this candlestick's closing price and this candlestick's opening price. There is a volume imbalance. So we cater to our volume imbalance because sometimes, more times than not, step index will want to fill in the inefficiency up to the volume imbalance. It tends to do that. And I'm going to give you an example of that very phenomena on the 15 minutes time frame. There's not a lot of price action going on the 4-hour time frame. So let's hop into the main course of this video. Here's the business on the 15 minutes time frame. This is our 4-hour time frame new week inefficiency, and we've graded that into quadrants. So today we had a bit of an interesting price action. We opened here, we consolidated as well, and we rushed to the upside to print relative equal highs at the 75% of the quadrant. So here is the lesson about order blocks with people. I hear people teaching about order blocks, but they don't tell you the full story. If you're met with a consolidation, and as I teach it, consolidation markets have to be paired with a PD array that is best suited for that market condition, which is a consolidation. So here is how you apply your order blocks into your entry timeframes. Okay, I do my entries on the 15 minutes time frame. Right down here we have the 20th of October's opening price. Price traded aggressively lower and it almost touched the 20th opening price, and then it retraced all the way back into the 4-hour time frame bullish order block. It hits the particular level opening price of the 4-hour time frame order block, and it prints consecutive down candlesticks. These consecutive down candlesticks, they make up your bullish order block. All right. Of all of the bullish order blocks that you see here, in this consolidation, these down consecutive candlesticks, they make up your highest form of a bullish order block. All right. How do you know that this is your bullish order block? How do you qualify a high probability bullish order block? Well, it has to be anchored to a higher time frame PD array. Okay, so here is the 20th. It drops down lower, hits the 20th opening price, and it rallies to the upside. Okay, all this time along, price has been accumulating at the 4-hour time frame bullish order block. This is a sensitive key PD array. So price has been treating the 4-hour time frame key PD array, which is a bullish order block, multiple times. But now, if you look into it, we have these down consecutive candlesticks. This makes up your entry in the lower time frames, like the 15 minutes time frame that we're talking about here. Why does this qualify as a high probability order block? Well, if we draw the high of the order block down to the low, right, we have a high probability bullish order block here. You want to see price action remain above the 50% of the bullish order block of the 15 minutes time frame. We call that particular key level, the 50%, as the mean threshold. All right. So if you were to enter along at the 8100.4 at the bullish order block on the 4-hour time frame and the 15 minutes time frame order block as well, this would be your entry. Okay, and your stop loss needs to be at the 20th price action low right here. If you want to have a tight stop loss, then your stop loss needs to go below the mean threshold of the order block. The 50% of it, yes, it has to go below it, because in some instances, price action tends to drop a little bit lower and it targets the 50%. So your stop loss would be below the 50%. Okay, but I would recommend that you place your stop loss at the low of the bullish order block. So now, if you have your entry based on the bullish order block on the 15 minutes time frame, where is your liquidity pools? 75% of that 4-hour time frame new week inefficiency. Yes, your algorithmic price signature has told you that this is where the buy side liquidity pool is. And on Sunday as well, it has also tipped its hand, showing you that there is relative equal highs that are close to this particular high. Today, the algorithmic price signature has tipped its hand. What you wait for is for price action to retrace back to where it came from. All right, so here is the paint and brush analogy. All right, here is the price action hitting the 20th opening price. It rushes away, meaning that if you are a painter applying your paint from the 20th price action, the opening price of that. This is where you start to paint. You roll your paintbrush to the upside. Well, if you look back, there is a spot that you missed. That makes it a fair value gap. That makes a fair value gap. This is the spot that you missed. Okay. This inefficiency, if I zoom in a little bit, this inefficiency has a volume imbalance right there. There is a separation between this candlestick's closing price and this candlestick's opening price inside of your bullish order block on the 15 minutes time frame, right? So what we do with that particular key fair value gap, we tend to annotate it this way. This is how I teach you to annotate your fair value gap if it has a volume imbalance down here. So here is how you draw your inefficiency. You draw it from the volume imbalance all the way up into the fair value gap high as well. If it has another volume imbalance, then you anchor your inefficiency fair value gap to that upper inefficiency as well, the volume imbalance. You don't draw your fair value gap like this, okay? You don't do it. Why? Because sometimes price action can draw all the way down into the volume imbalance with people. So this right here is where I have my entry at the volume imbalance. All right. Down here as well, as you can clearly see, it has hit the volume imbalance. So this is the second time that it is coming down to hit the volume imbalance. And that, ladies and gentlemen, that is your highest form of a setup. If you have entered at the volume imbalance / fair value gap, where is the draw on liquidity? Where is price trying to get to? Well, there is the 75% quadrant from our new week fair value gap. That is your algorithmic price signature tipping its hand, telling you that's where the buy side liquidity pool is. Okay, so hopefully you learned a lot about this order block entry mechanism. You have to anchor your order block into the higher time frames. Your order block has to trade inside of the higher time frame key PD arrays. Otherwise, it's not going to be as effective. Okay, so this is it, guys. I will see you on the next coming video.